What's going on, everyone? I got an awesome video for you guys today. I say that every time, but I promise you, just like all the other videos, this one is equally as awesome. This one's about something called a market order, and it's something that I completely avoid at all costs, and I'll show you why in this video. Interestingly enough, this video was supposed to be serving the purpose of educating and allowing you to learn more, as opposed to some of our other videos where we're doing strategies, we're implementing strategies, we're executing strategies where the goal is to either make money or save money. It turns out this content about market orders went from an educational video to something that's going to end up saving you a ton of money over the course of your investing career. So it's really, really important you guys focus for this one, because you might be doing something completely wrong, like placing a market order that you didn't even know you were doing. So it's very, very important that you guys lock into this. Again, in this video, I'm going to talk to you what a market order is, why I absolutely avoid market orders at all costs. Hint, they're absolutely horrible. There's nothing good about them. Well, maybe one thing, but there's pretty much nothing good about them. The type of order that you could place that's way better than a market order, and comparing the two, how much money you will be losing or making just by doing the wrong type of order. So here we go. I'll be inside the computer here in a second, guys. Strap in, this is going to be going. Why I never use the market order, and after this, I promise you, you will not be using market orders either. So I'll see you guys right there inside of that thing, the computer. Okay, boys and girls, ladies and gentlemen, children of all ages. Here we are, why I never place a market order. And this is really interesting because all online trading platforms, for the most part, are auto set to placing a market order. There's one reason for that. We'll get into that here in a second, but it's really, really interesting. Market orders are horrible. Market orders are atrocious. They're something that you need to avoid at all costs. There's absolutely nothing good about them. There's one positive about them, but it's not even that good. So again, it's really strange because a market order is something that automatically has you losing money, and we'll talk about here why in a second, which is so crazy as why all the online brokerages have market orders as the default order. Now, I talk about this in other videos. We had another video on this channel talking about what to do when looking at a bid-ask spread. Similar to that video, we're talking about market orders. In the stock market, there are not that many things that you have complete control over. You don't have control over interest rates. You don't have control over if a stock goes up or down. You don't have control over their share buyback program, what the dividend is, what the foreign exchange looks like. You don't really have control over any of that. You do have control over what type of order you're trying to execute. You do have control over it. And what's amazing and what's really, really cool is the type of order that you place, that you again have 100% control over, is something that you can actually do, and doing it the right way can actually make or break your year for you. And it's crazy. I know you're probably sitting there like, how can an order type, especially the one that's set as the default for my online brokerage platform, how could that actually hurt me? How could that actually allow me to lose money? You'll be shocked, but it's true. And the reality is we're going to show you the type of order that you should be making, and you will be smiling too once you know how easy it is, how simple it is to really put the odds in your favor, especially when talking about things in the stock market that you have control over. That's why I'm really, really excited about this. Again, guys, the goal of this video originally was just to talk about market orders versus other type of orders. And as we dug deeper, we ended up doing a pretty big study, a pretty thorough study. We ended up finding one that really uncovered really how nasty market orders are, how much they could really hurt your overall gains, and how effective other types of orders are. So here we go. Why I never place a market order, and why you will not do it ever again if you are right now, I promise you. So for starters, what is a market order? Okay? A market order is an order to either buy or sell stock, options, or future contracts, which the buyer or the seller chooses to execute their order at the current market price, right? At the current market price, hence market order. And we'll get into that just here in a second, right? The only benefit in the world for a market order is the speed in which an order is executed. In pretty much every stock in the world, there is always a current market. And when you place a market order, you will get filled instantly. That's very much the only benefit. I'm telling you guys, that is the only benefit of a market order. That is it. And speed is nice. Look, speed is great. The ability to get in and out whenever we'd like to is a huge part of investing. However, the cons and the trade-offs with actually putting in this market order and utilizing this market order completely outweigh its only benefit, which again is speed. So let's just recap here for a second, guys, because we've gone through some pretty important stuff. This is the normal, this is the predetermined, this is the standard type of order on all online trading platforms, a market order, where if you're a buyer, you will buy at the current market price. If you're a seller, you'll sell at the current market price. And the only benefit is speed. This is the default order. Now, what is a market? Because remember, a market order is executed instantly at the current market price. Well, let's talk about what a market is. All right? So according to Investopedia, a market is a medium that allows buyers and sellers of a specific good or service to interact in order to facilitate an exchange. Okay, that's nice, right? That's a very that's a lot of SAT words in there. That's very advanced. Blah blah blah. That's great. What I'm looking at right now is the bid and ask spread in Google. We all know Google, the largest search engine in the world, owns things like Waze and Nest. We in Gmail. We touch Google every single day of our lives. Right now, for the stock of Google, this is what the market looks like. The market is the two-sided action. It's the bids and the asks. That's what together creates a market. And remember, a market order is instantly buying or selling at the current market price. Right now in Google, or at least in this screenshot, the bid, which is the most amount of money someone is willing to pay for stock, is $1,052.71. Right? That is the bid, the most someone's willing to pay. The ask, which is the least amount of money someone is willing to sell for, is $1,053.21. This is the market. The bid and the ask about 50 cents wide away. That is the market with the mid price of $10.52.96. This is what a market is. This is what a market is. So why do they stink? Remember, I told you, I never use market orders. They nail you over the course of your trading career, over the course of a trade, a day. They really take away from your profits, and you're really not saving as much money as you could just by using other types of orders. So why do these market orders stink? Remember, I told you at the end of this, you were never going to use a market order before. Even though it's the default. It's the default on your trading platform. Market orders stink because in order to execute the trade, you have to trade at the market price. Right? As a buyer of a market order, you have to pay the ask because the ask is the lowest amount of money someone is willing to sell for. And if you're a seller and you place a market order, you have to pay the bid, which is the most amount of money someone is willing to pay. That is a market. If you're going to a market and you're looking to buy instantly, the person who's willing to sell for the lowest amount of money is the market. And if you're a seller and you're looking to go in there and have someone buy your shares, the market is the most someone is willing to pay. So the market is pretty much the bid and the ask, with the mid price again of $10.52.96. That's 25 cents away from the bid and 25 cents away from the ask. That's the mid price. And as a buyer, when we execute a market order, although it is fast, I admit it's fast, we have to pay the ask. The ask is 25 cents above the mid price, and we're doing that just to execute the trade. Which means, as you guys have already understood, that we are willingly taking a loss of 25 cents per share just for placing a market order. Now, you might be sitting there going, Stephen, 25 cents a share, not that big of a deal. Well, on average, the average trade size is default to 100 shares. That's $25 per 100 shares, not even counting commissions, which add to it. Now, again, we started off by saying there are only so many things in the stock market you can control. right? One of the things you can control is the type of order you're executing. Here, you are willingly using an order that causes you to take an immediate loss just to enter the position. That is an absolute no-no. That is an absolute no-no. So guys, that is ugly, right? So 25 cents a share can add up. If you do that for 100 shares, that's $25 per 100 shares. If you do that once a day for a week, that's a $125 loss a week just to enter trades. Forget the fact if they go up and down in your way or in your favor. You're paying, without even considering commissions, extra money. You're taking an immediate loss just to enter the position. Forget about the fact that the stock still has to go in your favor. Forget about the fact that all those things are out of your control, like what the stock does, what the dividend, what happens to the dividend, the share buybacks, currency. Forget about all that stuff. You are literally taking a loss just to enter the position with a market order, right? But what's crazy is it can actually get worse than that. It can actually get worse than that. So what if I told you something that was really ugly? Right? So what if I told you that the market, right? Remember, we said the market are the bids and the asks. The bid being the most amount of money someone is willing to pay for, and the ask, the lowest amount of money someone is willing to sell for. So if we're a buyer, right, we don't pay the bid. The bid is not the market. The bid is the lowest amount of money someone is willing to sell us those shares for. That is the ask, right? But what if there are people that can actually see the types of orders you're putting in? And what if I told you that the people, they can see your order, and not only that, but they could change their bid or the ask, the market, right? Because the bid and the ask are the market, and they could change the market depending on your order. And what if I told you that that's too bad for you, right? And if you wanted to buy a stock and you put in a market order, they could see your market order and they could remove their ask and put their ask at a different price to make that price the current market, and you will still have to pay because you committed to putting in a market order. Nowadays, high-frequency traders, high-frequency algorithms, they are the market. They are the bids and the asks. High-frequency traders, because of their co-location, can see your orders from the time you place them. And because their servers are so close to the exchange, they can see your orders. They can see exactly what you place. And before that order is executed, right, they can move their ask up higher than they want. So right now we see bid of 1052.71 and an ask of 1053.21. We know that the mid price is 1052.96. However, when we see a ask like this of 1053.21 and we put in a market order as a buy, we know that the current market for buyers is 1052.31. So we're expecting to have to pay 25 cents a share over mid price just to execute the position. But however, high frequency traders, what they do, and they do this a lot, and you'll see here in a second, which is kind of why this is so mind-blowing. You'll see this here in a second, right? They will pull their ask, and the market will no longer be 1053.21. They could raise it to something like 1055, and you will still have to pay 1055 because that is the current market price that you have committed to buying your shares for with a market order. They can move it up to 1055, and instead of taking a 25 cents per share loss just to buy, in this scenario, you're taking a $2.04. So while 25 cents a share over 100 shares is only $25, $2.04 per share over 100 shares is $204 just to enter a position. That is the amount of loss you have to take. And this is kind of where I wanted to take it and leave it at there because, hey, market orders are no good. But the reality is, this is a much more real scenario than I ever could have imagined. How scary is that? This scenario Where the high frequency traders, those who are the actual market, are pulling their orders because they can see what you're doing and kind of hurt you on the other side. I don't use market orders. This never really affects me. But this is a far more realistic scenario than I could have ever imagined, which is kind of why this is scary. So there was a study done in 2016 by BATS. BATS is the CBOE, the Chicago Board of Exchange Equities Exchange. They facilitate a large portion of the trades that go on a given day on the New York Stock Exchange. And that study in 2016 by BATS showed that 88% of all market buy orders resulted in the exchange of shares above the mid-price. Above the mid-price between the bid and the ask. So when we look here, we see the bid of 1052.21 and we see an ask of 1053.21. The mid-price of that is 1052.29. But what BATS is saying is that 88% of buy orders, 88% of all market buy orders result in the exchange of shares above the mid-price between the bid and the ask. So what they're saying is 88% of the time, in a scenario where we have a bid-ask spread that's 50 cents wide, you will have to pay over the mid-price 88% of the time, which means that means taking a 25% loss per share would be like, a gift from the gods, would be like a miracle. You only have a 12% chance of being filled at mid-price because you have an 88% chance of being filled worse than mid-price. That is horrible. Horrible. So if you choose to execute a market order, which again, unfortunately, is the default type of order for most online brokerage accounts, you are willingly choosing to overpay and take a loss to enter the trade 88% of the time. Let me repeat myself. If you place a market order, you are choosing to overpay and take a loss to enter the position 88% of the time. In the stock market, you only have control over a few things. The type of order that you place, you have control over. If you place a market order, you are willingly taking a loss 88% of the time. Not good, but luckily, there's something called a limit order that can solve our problems. So again, here's the bid and the ask of Google. Limit orders, they differ from market orders. Where limit orders, they set a limit price where the order has to be executed at that price or better. Remember, with a market order, you're getting filled at a worse than mid-price 88% of the time. But with a limit order, you cannot get filled at a worse price than the price you put in. So for the example here, with a limit order, if you want to buy shares of Google at 1052.72, we place a limit order for that price, and the absolute worst price we will get filled at is 1052.72, which means we will not have to take an immediate loss just to enter the position. Again, guys, you might be thinking, wow, this is no big deal, I know that. But think about it, the people out there that are using market orders, how much money they're just giving away just to enter the positions using the wrong type of order. It's crazy. Now, let's go down the rabbit hole a little bit more. A little more facts. A different study in 2016 by BATS, again, which is the Chicago Board of Exchange Equities Exchange, showed that 61% of all limit buy orders resulted in the exchange of shares at a better than the limit price. That's right. More than half of the time, if you choose a limit order, you will get improved on your price. So the example we talked about here, where we had a limit order of Google at 1052.72, according to BATS, 61% of the time, you're not even going to have to pay 1052.72. You get to pay a lesser price 61% of the time. Guys, this is game-changing stuff, especially because, again, the default order on most online brokerage accounts is a market order. So, again, guys, remember, in the stock market, I can't say this enough, in the stock market, there are only so many things you guys can control, and I can control. There are only so many things. The type of order that we place is something we have control over. So now we have an actual conscious choice, quantifiable choice. With a market order, according to Bats, we get filled at a worse price 88% of the time. With limit orders, according to the same company, Bats, you get filled at a better price with limit orders 61% of the time. Guys, this is amazing, amazing, amazing stuff. And the good news is, again, placing a limit order is a choice, and it allows you to put the odds on your side. So crucial, guys. So crucial. I can't screenshot this, write this down, whatever you need to do. With a market order, you are choosing to get filled at a worse price, which means you are choosing to take a loss to enter the position 88% of the time. With the limit order, you are choosing to save money and get filled at a better price than the price you put in 61% of the time. I don't know about you guys, but I want to do limit orders. In fact, I would love for there to be a way to actually completely remove market orders from my online trading platform. That's how bad they are. So as you guys can see, I'm in my Thinkorswim platform by TD Ameritrade. Again, they don't pay me to talk about this. This is just the only platform I've ever used. What we can see here is I've simulated buying 100 shares of Facebook. Facebook, you know, I was on Facebook Hours today. I'm sure everyone watching this video has been on Facebook Hours in the last week or so. Great company as well. The management team is phenomenal. All that jazz. Facebook. As you can see, the default order in this list, there are like 8 different types of orders. I only use limit orders, but as you can see, the market order is the default order. If we want to buy 100 shares of Facebook, right now the bid is 180.25 and the ask is 180.49. If I want to buy 100 shares of Facebook, I have an 88% chance of being filled above mid-price. So 180.25 plus 180.49, and then we're going to divide that by 2, just because I'm not as smart as you guys think. Divided by 2, the mid-price is 180.37. So 88% of the time, I will get filled above 180.37 with a market order. And the reason for that is because the ask is the current market. And again, that is much greater. The ask is 180.49 and the mid price is 180.37. So 88% of the time, if I willingly place a market order, which is the default on all these online brokerage accounts and all these trading platforms, I will get filled at a worse price than mid price 88% of the time. However, if I just go like that, I can actually put in whatever price I want. And again, while you might not get filled as fast as, say, a market order because there's always a market, you will get filled at a better price 61% of the time. And all I did was change the order type from market to limit. That's it. Those 3 seconds make a huge effect on my P&L for the day, for the week, for the month, for the year, and in my trading career. Think about it. If you had to pay 25 cents a share over mid-price, over fair value, if you had to take a 25-cent loss per share every single time you made a trade, you would be out of an account in no time. It's absolutely crazy. You know, only so many things you can control, guys. Taking something like this, clicking this button, and doing that is something you can control, and it will save you a ton of money over the course of your career. So there you have it, guys. Why I never use a market order and why you will never do it as well. Something so simple, something as the default order on your online brokerage account, on your trading platform, can be very, very costly over time. So as a recap, guys, what did we talk about? Market orders. Yes, they're fast because there's always a market. However, the market will end up ripping you to shreds. You, according to Bats, have to pay worse than mid-price 88% of the time when you execute a market order. But if you take those 3 seconds to place a limit order, you will be on the other side, and you have a 61% chance of being filled at a better price than what you put in as your limit. One side, market order, you're going to have to lose money 88% of the time just to enter the trade. On the other side, a limit order, you have a 61% chance of making money, right? Of making money because you get filled at better than your price just to enter the trade. The choice is yours, guys. If you have any questions, if you want any more information about this, hit me up in the comments below. I'll see you guys in the next video.